Okay. I'm gonna talk about a report that I just saw, which thing. Testing. Oh. Lots of things happening in the market right now. And I guess everyone is looking. We all know it's too much, but we don't want to be FOMO, fear of missing out. Everyone is kind investing. Do you think these space stocks still have room to run? Well, the question is this. Well, let's put it this way. If you were to mimic the way we are now versus all the other crash, .com, not just that one. I did a video on that a while back, where they basically tag where the market is right now with where everyone compared to where it was in the past. We're not there yet. So if you mimic them, we're like halfway through. The second thing is, the truly stock market quote unquote crash, where the market drops by 15%. When was that last one? In 2020. Then we did 2008. Then we did 1987, where the market dropped by 15%, like in one day. The only time we went 20% was in 1987. 2020, there's still more room to go technically. Now, of course, this could be like the market crash, the .com era. That didn't crash in one day. That took about 3 years, but we lost 78%, and it took 15 years to get back. Now, having said all that, you can't compare too much because right now we have $37 trillion worth of debt. Rightfully or wrongfully, the US is pissing up everyone in the world. For good reason. If you know what's really going on, the US needs to do what it needs to do right now because it's losing ground. Now, maybe it's doing it a bit too forcefully, but it's losing ground in terms of API pharmaceutical out of it eventually lost that battle. Oh, China and India, you don't make medication in the US, that kind of medication, the everyday medication. The US is still good with biotech, but it's having difficulties competing. It's going to lose the semiconductor competition very soon as well, because it's losing out to, again, China and these countries. It lost the rare earth mineral battle. It's going to take at least 3 to 4 years before the US is able to ramp it up. Not that the US does not have rare earth minerals, but you have to start to learn how to do it again, which you forgot. So you have to go and beg with China. And you have solar. It's over. You lost that battle. Shipbuilding, construction, no, that's out of China as well. So, you might be losing the AI race. it's in the process of losing the biotech race to China. China is creating more. It's creating more molecules. It's finding out more molecules, new molecules, than the U.S. in terms of biotech. China's got DeepSeek, right? It's got its own thing now. I mean, it's mostly used over there, not so much over here. So the U.S. needs to do something. And of course, it's got a large trade deficit and it's got a huge amount of debt. So yeah, the U.S. is a quote unquote rich country. It's rich because it's got a huge credit card and it's been using a lot of it. It's a rich country because a lot of resources. That's true. And it's a rich country mostly because of the dollar. 50% of transactions in the US are done in the world are done with the dollar. If the US were ever to lose that dollar, how are you going to repay 37 trillion? Nobody's going to want dollars anymore. So that could be a huge issue for the US. And that, my friend, is what they're mostly worried about. They're mostly worried that they're in the so what do you do before you lose? You got to start something, and that's kind of what the U.S. is doing. It's gonna grab onto Venezuela, probably for security purposes. Believe it or not, Venezuela was in the process of building a drone factory made by Iran of all people, so that didn't look too good. Um, what was it going to do? It was going to start doing a lot of other things that just a bit problematic in terms of Cuba and all that. But I mean, trying to protect itself with the Greenland. And it was in the process of doing the same thing with trying to control what is it that they were trying to do? They're trying to Venezuela, Greenland, Canada. Now, I don't know if you know, but today the US said to Canada, listen, if you're going to do business with Chinese, I'm going to tax you 100%. So, yes, everyone is bringing that to one individual, saying, well, look what he's doing. But he's got a bunch of people advising him, quite frankly. And on the other side, they will tell you he's a crazy person, therefore don't listen to what he's doing. But if you don't believe that, the way you should read this as an investor is, the U.S. is in trouble for these aspects of things. Now, of course, you could have said nothing and keep it going the way it was, but the U.S. could not keep going the way it was going. It needs to do something. Now, did it do anything? That's a question. Is it accomplishing anything right now? You're not going to know that for a while. Okay, that's going to take a while to figure out. But we'll see. So let me show you a slide that I put. It's basically a weekly recap as to what I think is interesting. It's a weekly report out of this firm out of Switzerland, of all places. And I thought that they put some interesting report. So let's take a look at what they have. Let's see what you think about this rendition of the market for the week. Okay, sorry, the wrong stuff. Now, don't forget to join my Patreon channel. The reason you want to do that is because I go in more details in terms of what I'm doing, what I'm buying. But at the end of the day, I want you to understand that you should not join my channel or my Patreon channel just to see what. Well, let's see what he's buying, so I could do the same. Now, don't do that. Don't do that, because what you want to do as an investor, I'm here to educate, explain to you what's going on. But anybody tells you that they know what's going on in the stock market, no, they're lying to you, because nobody knows. But what you do want to know, what you do want to do is, you want to try to get what is really going on. And what's really going on is, we don't know. But I'm here to teach you. I'm not here to give you a bunch of stocks and then say, yeah, these are going to double in 3 years, right? It doesn't work that way. You need to educate yourself. I got plenty of members, and they all want to know, what's going on, and tell me what the real story, because they're not really telling you what's really going on, unfortunately, and that's a fact. Okay, so let's start. Silver has crossed $100 an ounce for the first time in history. And but it's not just a speculative headline, right? This is a macro signal, and it is flashing red across currencies, equities, geopolitics, and household balance sheets simultaneously. In China, physical silver is trading near $135 an ounce. In Japan, it's closer to $142. That is not a normal market dislocation. That is stress in the global monetary system. What you're watching unfold in front of you, as far as the silver is concerned, is not a rally. It is a repricing of trust. This is how you need to take a look at it. Look carefully at the long-term silver chart that you're going to see on your screen. And you will notice three things. First, that is not a straight line move. It is a multi-decade compression followed by vertical release. Second, silver is outperforming relative to fiat money supply, even though critically it remains historical cheap when adjusted for global M2. Now, I will tell you, even though silver and gold are pretty high, relatively speaking, not on an absolute basis, but on a relative speaking, it has more to go, believe it or not. Third, retail participation is unprecedented. Physical silver, look, this is a chart I'm talking about. Physical silver ETFs have seen 169 consecutive days of inflows. Retail buying is now 2.1 times above the 3 months average. This exceeds the intensity of the 2021 silver squeeze. God tells the same story, but with a different audience. Gold is not a retail trade. Gold is a central bank trade. And what that means is that you're in the process of, repricing. China's U.S. Treasury holdings are at an 18-year lows, while its gold reserves are an all-time highs. This is not speculation. This is strategic reserve allocation. That is what this is. So, second, equities. Let's take a look at equities because equities are quite interesting right now. So let's take a look at equities. Now, at first glance, the market looks fine. And what I mean by that is breadth is strong. Over 65% of S&P 500 stocks are beating the index. But dig deeper. Fund managers' cash levels are at a record lows, just 3.2%. The Bank of America Bull and Bear indicator is at 9.3, one of the highest reading in 20 years. Historically, this is not bullish. This is contrarian danger. Institutions are quietly selling. 5 consecutive weeks of institutional equity outflows. Hedge funds and retails are buying what institutions are distributing. This is late cycle behavior, right? So mega cap tech is holding the index together, literally, but leadership is narrowing. Apple just logged 8 straight weekly declines. The Nasdaq is underperforming some small caps on a relative basis. Small caps. And join my Patreon channel or join the become a member on YouTube, and you will see me every morning coming to you and explain to you what I'm doing. Now, I don't want you to copy what I'm doing. I want you to understand what I'm doing. That's more important. Markets are no longer riding together. They are splintering. So one of the most important charts that you're going to see is comparing the NASDAQ 100 to the SAS index. And that divergence matters. For a decade, growth at any cost was rewarded. That era is over. AI has compressed the value of low-profit software models. Efficiency now beats vision. Margins beat narratives. Investors are no longer funding promises. They are demanding cash flow. They're demanding durability and pricing power. This is not a tech crash. This is re-ranking. So let's watch Japan, for example. Japan's government bond yields are multi-decade highs. 30-year is near 3.6. The 40-year is at 4%. This matters globally because Japan is not just a bond market. Japan is liquidity exporter. Now, if you don't understand some of the things that I'm talking about, that is good. Right? Because everybody understands everything, then there's no discovery. This is how you make money. You need to understand what you do not understand. So you could take advantage. Japan is a liquidity exporter. As domestic yields rise, the Japanese capital comes home. That tightens global financial conditions, especially for U.S. duration assets. This is why the long end of the U.S. Treasury curve is moving independently of Fed rhetoric. What does that mean? It means, but essentially, that the 10-year yield, the Treasury yield, is higher than the Fed fund rate. Rates are no longer set by central banks alone. They are being set by capital flows. Look at the Treasury yield. The 10-year, which basically your mortgage is set on in the US, is around 4.2 or 3%. It's higher than the Fed fund rate. It shouldn't be. Why is it higher? Because the traders know that there's inflation in the system and they don't trust the Fed anymore. The central banks, they're just flooding the system with cash. The dollar just posted its worst week since July. As the dollar weakens, global ex-US equities break out. Commodities surge. Precious metals accelerate. Layer geopolitics on top. Greenland is not a headline stunt. It's about Arctic trade routes, rare earth access, military positioning, and control of future maritime choke points. So this is about because I read the CIS Global Markets Weekly Wrap Up of January 24, 2026, and I'm kind of telling you what they're saying. And I'm agreeing with what they're saying. In terms of equities, in terms of silver, everybody knows. Well, I'm bringing it up to speed. But the question is, what are you going to do with the information? So the dollar weakens. Global layer. Greenland is not a headline stunt. It's about Arctic trade routes, rare earth access, military positioning, control of future maritime choke points. And as it recedes, as the ice recedes, geography becomes destiny again. Markets are repricing power, not just earnings. So everybody's feeling it, right? So you see it when households buy silver coins instead of index funds. Workers hedge inflation with tangible assets. Retail investors trade options at record volumes. Energy, food, and housing volatility shape daily decisions. Markets are no longer academics. They are personal. So what does this mean? It's not a call to panic, but to pay attention, right? When metals surge, currencies wobble, institutions sell into strength, and geopolitics reshape trade routes, you are not in a normal cycle. You are in a regime shift. I've been saying that for a while now. And regime shifts do not announce themselves politely. They repeat themselves through charts like the ones you just saw. What do you think of the oil sector in this geopolitical environment? The narrative now is the same as in 2000 when oil from 2050, the oil service company had, okay. So the oil sector. You need to understand that oil is highly correlated to basically inflation and the economy, okay? So if oils go up a lot, that means that you're going to create inflation, obviously. You're going to slow the economy down. The U.S. is a net exporter, technically, of oil. Doesn't need oil. Oil is going to be on its way down unless there is a war somewhere. But you have to understand also, and this is what is meant by the geopolitical, as far as oil is concerned, what the U.S. is basically doing is they are kind of solidifying the Fortress America. Now, why? What they want the oil? What do you think they want the oil? What if there's a major war with the European in a few years from now? Because they're rearming right now. And this is something that I talk about in my Patreon channel, where I said, start to look at defense stocks, especially European stocks. Take a look at emerging markets. I show you what I do there. It's important to understand that. The point is, what's going to happen with oil is that you're going to have a lot of countries that are going to produce it, especially in North America and South America. You're going to have a lot of oil. The oil is not about to explode. And if it does explode, don't worry, because in North America, they're going to be covered. Canada, although now US is going after Canada because of the deal with China. So oil, at the end of the day, is not bound to go up, even if there's a war in the Middle East. Okay, those days are gone. Oil is a weapon. It's going to be a weapon against Cuba, for example, and Venezuela, because Cuba, we're getting a lot of its oil with Venezuela. So to that end, you're going to be going on your way down. As far as crypto, the crypto situation, well, crypto is not doing so great right now, although right now it's undervalued. Gold is overvalued, but crypto is under. But crypto, at the end of the day, is becoming like a quote-unquote institutionalized investments. Don't expect, to make zillions of dollars from it going forward. That is not going to happen because now, and it's a good thing, because now it's the crypto is being institutionalized. That's what it's called. Let's talk about the U.S. price index versus a trading range. Let me show you this slide, which I think is interesting. Now I know it sounds like it's a class. Well, that's what I do all the time, but with my investors, but it is, you need to understand what's happening first before you make any decision. And of course, because most people don't understand, they want to know someone to tell them what to do. And I see it all the time on YouTube, and it's just wrong. Because you don't know what everybody's situation is. And you can't put them in investment they don't understand. But yet, what is true, there is something called the FOMO, the fear of missing out. And this is kind of what's happening here. Here we go. And look at this, beautiful. What you're looking at on the screen is not a price chart, not a valuation, and it's not earnings either. Take a look at the chart. Okay, I know it's, you should be able to see it, right? US indices price versus trading range as of 1/8/2026. So this is not a crash call, right? This is not a doom headline. This is none of that, right? So what I'm doing is take a look at it. So it's a warning that markets only whisper before they scream. What you're looking at on your screen is not a price chart. It's not a valuation. It's something far more dangerous when ignored. This is a market positioning and exhaustion map. And right now, almost every major US equity index is flashing the same message. You are late, risk is mispriced, and upside is shrinking fast. Let me show you. Let me show you exactly why. This is not a predictive chart. It does not tell you when something breaks. It tells you how vulnerable the market if something does. The correct answer, one question only, right? This chart answers one question only. Where are pricing sitting inside their trading range across the entire US equity complex? And when everything answers that question the same way, markets pay attention. So how are we going to read this chart first? Most investors misunderstand what they're seeing. On the left side is the index coverage. This chart runs top to bottom by market size, as you could see. First you've got the Russell 2000 all the way up to the S&P 100 ETF. So this is a breadth and momentum diagnostics. That's what this is. So what you're looking at is you go from micro caps all the way to mega cap benchmark. This matters because risk never hides in one corner, and it's all about risk. It migrates. And every segment lines up. It's what you call systemic risk. When everybody says sell, this is what you call systemic risk. So that's on the left. The middle section, you'll see three columns. The year-to-date, the 5 years, and 50 DMA, which is a distance from the 50-day moving average. So in the middle, year-to-date, you have the price, obviously, but you have the year-to-date, the 5 days, and the 50-day DMA. So here's the first red flag. Smaller stocks, micro, small, and mini caps, are outperforming short term. Look at it, right? The Russell, the macro cap, and the core S&P small cap ETF are outperforming the look at it. They outperforming the short term. Why do I say that? Well, look at the number. 4.9, 4.78, 4.4. Year to date, they are higher than, so basically, and this was something I've been saying since last year, go for the small caps. Look, compared to everything else, the Russell 100, the total stock market, and all that. And this is not a sign of safety. This is a sign of late cycle risk appetite. Small caps don't lead early stability. They lead liquidity chasing. But because everything is so high, you're going to have to, what else haven't we bought yet? The arrows tells you the trending direction. Take a look at the arrow on the right. It says trend. It's green, 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 orange, 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 green, 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 all green. Almost everything is still trending up. This is not a bearish trend breakdown. This is something more subtle and more dangerous. Now focus your eyes on the far right. That is where the message becomes unavoidable. Overbought, neutral. This is not an opinion. It's mathematically positioning relative to recent price changes. That's what it says. The black line and dot, the black line shows the full recent trading range. You could see how far it drops, and it basically, you could see it goes into overbought territory. All of them are the green and the orange. The white is, the white is neutral, but you have overbought, and this is where they are. With a little green arrow at the end, green circle. So the dot shows where price currently sits inside that range. Did you notice? They all sit at the end of the range on all of them. Dots on the far right edge means prices pressing the upper boundary. Upside historically slows and downside accelerates. Almost everything is flagged overboard. Not one sector, not one index, not one corner. Everything. That doesn't happen in a healthy early cycle market. So markets can't stay overboard forever. But markets rarely stay broadly overboard without consequences. When this happens, only three things follows. One, sideways churn that destroy returns through time. Fast pullbacks that reset position. Volatility spikes that punish leverage and complacency. Notice that this doesn't imply that there's going to be a crash tomorrow. It implies asymmetric risk. Upside becomes slow, the downside becomes fast. So basically, what we're doing, we're not saying sell everything. We're saying is you are aware that there's risk of crossing the street with your eyes closed. I'm not saying don't cross the street. I'm not saying you're going to get run over. I don't know. It's maybe midnight. There's no cars around, but you're crossing with your eyes closed. So let's look again at the top of the chart. The micro caps and small caps are the most overboard. This is historically critical. What do I mean? Well, small caps depend on liquidity. 2, depends on easy financial conditions. 3, they break first when risk tightens. They don't lead safely. They lead a late stage enthusiasm. When they roll, they rarely warn politely. Now notice something subtle but critical. The largest, most liquid indices, the mega cap tech, are only neutral, not overboard. You see what I'm talking about? If you go all the way down, the Invesco NASDAQ 100, that's the top 100, tech firm, basically. This tells us something powerful, that it's not a tech-led melt-up. This is a breath chase. Breath chases are quiet until they don't. So don't look at this chart as being bearish, but as unforgiving. It tells you risk is poorly priced. Positioning is crowded. Returns are being borrowed from the future. And the most dangerous thing investors can do here is confuse positive trend knowing with low risk. Because this chart is saying very clearly, you are no longer being paid for optimism. You are being charged for it. So manage accordingly. I mean, yield ambulance chases. Yeah. The problem is, I know. It's overboard. Yeah, but in the meantime, it keeps going up. You want me to sit on the sideline? I'm losing money if I sit on the sideline. I know. And that is the issue. You need to you need to be you want to be part of the game. But that is difficult. Let me show you. Let's do this thing on oil, because I found this quite interesting as well. Let's take a look at this. Thank you. Well, I'm trying to. You notice that everything that I do is all about relative pricing, not absolute. I'm not showing you prices going up. We all know it's going up. What I'm showing is it going too high? And you have to be very careful. So in a way, I charge a lot of money for my courses. But because of YouTube, I get lots of views and lots of members. I realize that it's more economical for you, quite frankly. For a few bucks a month, you get to have me talking to you every morning the same way I do to my other investors. But because there's many of you, it's worth it for me to do it. Let me show you. Let me show you this this oil business. Let's make it a slideshow so I get to see some moving images to watch. Look at these two charts. Hopefully you get to understand something about oil. This one. Slideshow 3. I mean, you probably don't understand everything, and I tell that to people that are not familiar, but that's okay. At least you get exposed to it, and I think that is more important because I know we've been talking about oil a lot and going on with oil and Venezuela and what the heck is the point? Okay, so I got two different charts here, not the same one twice. Let me see. Yeah, it's different. Okay, let's do this. Let's talk about that. And so let me just okay. So this is oil. Okay, this is something that investors don't fully appreciate. The United States, listen to this, has quietly become the single most important oil power in the world. Not because prices are high, not because OPEC has failed, and not because demand suddenly exploded, but because production scale, export capacity, and geopolitical leverage has shifted structurally. And the chart you're about to see proves it. And don't forget to subscribe to this channel, okay? Thumbs up. That's all I'm asking at this point. Today's discussion is not about oil prices. It's about power, energy power, trade power, inflation control, and the hidden constraint this places on global politics over the next decade. And this is also what's happening with silver and gold, believe it or not. It is becoming not just a commodity, but a strategic asset, a geopolitical tool to be used. So what are we looking at? Well, you have two charts. One of them is called, as you could see, the U.S. petroleum production continues to rise. And this basically runs from 1980 through 2025. And it's measured in million barrels per day. You could see 5 lines, and this is critical because this was a confusing start here. So let me do it very slowly. So you have a red line, which is production, a blue line, which is consumption, right there. The blue line, consumption, the green line, export, and the orange lines, imports. And the gray line, net imports. This is basically imports minus exports. When this goes negative, the U.S. is a net exporter. The shaded vertical bar represents recessions. Now watch what happens over time. 1980 to 2008. From 1980 to 2008, this chart tells you a very simple story. The production slowly declines. The consumption steadily rises. Production goes down. Consumption goes up. Import surge. This is structural dependency, right? You need it. The U.S. economy grew by outsourcing its energy vulnerability. Every recession during this period was amplified by oil exposure. 1980 to 2008. Inflation shocks, trade deficit, geopolitical leverage held by others. At that point, the US is a price taker, not a price maker. Then 2008 to 2010, look at it. This is where the entire global energy order begins to bend. Production stops falling. Nobody wants it. Then it rises. And it never looks back. This is not a cyclical recovery. This is a technological regime shift. Horizontal drilling, hydraulic fracturing, logistics scale, capital markets willing to fund it. This is a shale revolution, and it rewrites everything. Then you got 2010 to 2025. Production explodes upward. Look at the red line. Look at the red line going up. Consumption stays flat. Exports surge aggressively. Imports decline. When net imports go negative, the US is no longer dependent. It is dominant. By 2025, production approaches 22 million barrels per day, and level no country in history has sustained. Exports rises above 10 million barrels per day. This is systemic supply. What does this chart really mean? It's not about oil. It's about inflation buffering, trade balance insulation. Energy is no longer a constraint on US policy. It's a tool. And now we move to the second chart, where the power shows up globally, right? That chart. The second chart is titled, US share of global oil production has increased from 8% to 20% today. This is a share chart, not volume, okay? You are seeing percent of global production for three countries, United States, Saudi Arabia, Venezuela. Measured from the early 1990s to 2025. This is not about who pumps the most today, right? This is the one about who controls over marginal supply. Marginal supply sets the price. Marginal supply sets the power. Right? You could see the United States is in red. Saudi Arabia is in blue. Venezuela is kind of in orangey and is just dying. Look at the red line. The red line is everything. The red line is the US. And that's amazing how high it is going. Now, what it's really doing, that is what I want to talk to you about. Okay? What does it really mean, right? So basically, it's what we call it the US the US power shifts. So essentially, we're looking at the second chart right now. So we're looking at, so what is this chart telling us? Let me look at it again. So US chart of global oil production has increased. This is a chart. So basically, you're seeing the three, which I just showed you. And this is about who gained control over marginal supply. The US collapsed, then ascend. Notice the US line. It declined steadily in 2009, right? Through 2000, the red line goes down and down and down and down, right? And then it reverses violently. By 2025, the US approaches 20% of global oil production. This is a 2.5 increase in global market shares in 15 years. No empire has done this quietly before. I mean, Saudi Arabia remains, relatively stable, slightly declining. It still matters, but it's conditional. Now look at Venezuela, once a major producer, now almost irrelevant. And that happens when politics override capital discipline. Infrastructure decays, sanctions intersect with mismanagement. This line is not just a statistic, it's a case study in lost sovereignty. So what are the strategic consequences? This shift explains everything. When oil price spikes fade faster, why sanctions are more enforceable and why inflation shocks are less persistent. Why the US can tolerate geopolitical risk better than others. Why do you think the US is going all over the world, doing what it does? Because it can tolerate geopolitical risk better than the others. Energy dominance allows higher deficit, higher defense spending, more aggressive foreign policy, greater tolerance for trade conflict. This is not theory. It is visible in the charts. And here's a final point, and it matters. The dominance doesn't guarantee high oil prices. In fact, it caps when energy equities behave differently, inflation behaves differently, and geopolitical leverage behaves differently. The mistake is assuming the oil playbook still applies. It doesn't. The US didn't just become energy independent. It became the global swing producer. And once you see that, you can't unseen it. This is something major that is happening for the US right now. Look at the chart. And you have to understand that if I know that, you know that, they know that too. They're controlling. Now, why is the US throwing its weight around, right? Because I can, and I can afford to. A, I've got oil. B, I have the dollar. And C, I have a huge amount of power. I need to do what needs to get done because I cannot, because at the end of the day, I will tell you what's going on. This is all about China. It's all about China. Remember that. And they better do it that way because the alternatives you're not going to like. And as far as the market is concerned, as long as we keep talking that the market is going to crash, the market is not going to crash. Why? Because the more you talk about it, the more people look at the numbers. And if you wait long enough, the earnings are going to catch up to the rhetoric. And don't forget, the Max 7 are not doing so well right now. So it's not like they keep going up. The market is up because it's being replaced by the small caps. And I'll do a video on that to show you what's happening. Next. Let's take a look at the top mineral producers. Let's take a look at this one. Look, let's take a look at the other commodities because there's something going on with commodities that I think you guys need to understand. It's important to understand. And why is it important to understand? Because again, this is not about commodities, it's about strategic assets more than anything else now, unfortunately. Or fortunately, you know. Give me a second. Look at this. Take a look. Let's talk about geopolitical risk tied to all the everything that's happening with materials, gold, silver, and all that stuff. I think people do need to understand. This is not a commodity chart. It's a map of geopolitical leverage. Every percentage point on this graphic represents control over growth, technology and defense capability, and inflation. In the next global crisis, the constraint will not be capital. It will not be labor. It will not be materials. This single chart explains why trade wars are escalating, why industrial policy has replaced free trade, and why the energy transition is far more fragile than markets currently price. So let's understand what this chart actually shows. This chart displays global mining production share expressed in percentages for critical minerals. Key rules for reading it. Each mineral is shown independently. The percentage represents current annual production, net reserves, not reserves, right? That's a production, not the reserves. Metals indicate rank order, not importance. This does not show processing dominance, only extraction. Okay, so that distinction is crucial. Production today equals pricing power today. Reserves only matter if they can be modelized politically and economically. Let's talk about cobalt. The most extreme concentration risk. Cobalt is the clearest example of single point failure in the global system. 76% of cobalt comes from the Republic of Congo. What do I care about cobalt? Let me tell you why. It's not diversification, it's dependency, because 9% is from Indonesia and 3% from Russia. 76% of cobalt come from Congo. Cobalt is essential for EV batteries, grid storage, defense electronics, and aerospace alloys. Any political instability, export restriction, infrastructure disruption immediately propagates into EV prices, battery supply, and inflation expectations. Markets systematically underestimate this vulnerability. Keep that in mind. Copper. Copper is not optional, right? It's a circulatory system of electrification. Who are the leaders? Congo, 14%, Chile, 23%, and Peru. Every EV requires roughly 4 times more copper than a combustion engine vehicle. EV, Every data center, AI cluster, and grid upgrade compounds this demand. Copper inflation is structural, not cyclical. Gold. Gold production reflects political intent, not speculation. China with 11% of reserve, Russia 9%, and Australia 9%. These nations are not chasing yield. They are hedging against sanction, dollar weaponization. Russia. The US weaponized the dollar against Russia. They said, you're attacking Ukraine, then you have no access to the dollar anymore. And say, fine, I'll go see my BRICS friends. And financial fragmentation. Gold remains collateral when trust fails. Lithium. Lithium is abundant everywhere. But the lithium processing is not. 36% come from Australia and 20% from Chile. And 17% from China. Extraction is not equal control. China leverages light downstream in refining, cathode, and cell manufacturing. That is why industrial policy has replaced globalization. Because in the past, we could have everything with everyone. But now, not anymore. Nickel tells us how nations weaponize supply chain. Indonesia is 60% of nickel production in the entire world. Indonesia's exports ban force global reshoring of processing. This is industrial policy in its purest form. Now here's a big one. Rare earth. They're not rare. First of all, you need to understand that everybody's got those minerals. Just that to dig them, the production is difficult. And you know what? Who has 69% of rare earth production in the world? China. United States is second with 11%. Every missile guidance, and did a video on that already, EV motor and radar array depends on this category. This is why export controls escalate quietly here first. Silver. 25% comes from Mexico, 13% from China, 12% from Peru. It's both inflation hedge and energy input. This duality makes it uniquely volatile in energy transitions. Uranium. 39% from Kazakhstan and 24% from Canada. When energy security overrides politics, nuclear will return. It always does. So, in conclusion, what are we saying? Well, this chart tells us four things clearly. 1, supply chains are dangerously concentrated. 2, processing beats extractions. 3, energy transition equals resource nationalism. 4, inflation is now structural and geopolitical. The next crisis does not begin in market. It begins in a mine, a port, a processing facility. And you could see how intertwined this world is, which is great. But what happens when it starts to break down? And what you're seeing with what the US is doing right now, they're saying, I don't want to play with you guys anymore. I'm taking my chips back. And the Europeans saying, what? But I thought you were going to take care of us. Now you're becoming a big bully. You say, I'm not becoming a bully. I'm taking my chips and I'm going home with it. It's too expensive. I can't carry you all. I mean, I don't know if you've ever seen how much money the US is spending on NATO versus the rest of the countries. US can't afford it with $37 trillion. It's over. Over. So they're going home, they're taking their chips, and they want to play with North America. That is what's happening. This is a new world order. The old world order is gone. Now, I know that Europe is trying to arm up and say, well, we don't need you anymore. This is very disappointing. I thought you were this great free country where everything was possible and blah. Yeah, sure. I mean, when it was okay for the Americans to spend so much money so that you didn't have to spend the money so you could spend it on your, so your social, free this, free that, free this. Well, the Americans are working, but no more. So you have to be careful what you listen to when you hear the rhetoric. Because the rhetoric is going to be bent it one way and bent the other way. You need to know the facts. Now, of course, you're going to say, well, this is going to make me money. It could make you a lot of money. Because if this whole thing collapses and you have no access to gold and silver and copper and all these things, these prices are going to shoot up. Rare earth minerals. I talk about this to my subscribers all the time. And my members say, look, this is the good companies to own because in a couple of years from now, they're going to be the major supplier of rare earth minerals. So you should do that.